Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets in Minds, the show where we break down big macro themes into simplified trade ideas. World leaders gathered at the United Nations in New York last week for the 76th session of the organization's General Assembly. Climate and the environment were high on the agenda for the U.S. President Joe Biden, who pledged to double the financial aid that the U.S. provides to developing nations to help them decarbonize their economies, a pledge that would take U.S. funding in this area to $11 billion per annum. The General Assembly came just 40 days ahead of a key climate summit, COP26, which will be held in the UK and be hosted by Prime Minister Boris Johnson, who told world leaders at the UN that the summit must be a turning point for humanity. Johnson likened the world's current attitudes to climate change to that of an adolescent who was just old enough to get themselves into serious trouble, as they could drive and knew where the keys to the drinks cabinet were hidden, etc. However, he warned that it was time for humanity to stop partying and grow up, as these kinds of behaviors were not only potentially embarrassing, but also potentially terminal. And therefore, as a species, we need to change our ways. The debate about climate change and the best way to deal with it rumbles on, of course. However, as traders and investors, we need to detach ourselves from the argument and look at the effect that the debate and changing attitudes among money managers are having on the market. These effects are tangible and create numerous trading opportunities. For example, here's the chart of U.S. coal company Peabody Energy. Coal is public enemy number one as far as the climate lobby are concerned, and as we can see, Peabody Energy's share price fell dramatically from February 2019. However, as economies emerged from COVID lockdowns, energy prices, and in particular natural gas, rose to a point where coal was in demand once more, and the share price of BTU rose sharply as a result. In fact, over the last 6 months, the stock is up by 371% despite a 12% correction over the last week. We can clearly see the correlation between natural gas prices and those of Peabody Energy's stock, drawn in red in this chart. So, what other trading opportunities do changing attitudes around the climate and the environment create for traders? One obvious opportunity is created by the flow of funds into ESG investments. According to data from research house Lipper Analytics, the amount of money invested in sustainable funds reached $1.7 trillion by the end of March 2021. That number was double the value of the figure from 2 years before. Whilst as much as 90% of the $1.36 billion of new money invested into UK equities during July went into ESG funds. That statistic highlights an imbalance around environmental, social, and governance, or ESG, investing, because to date, the vast majority of the money that's moved into the sector has come from Europe, and not the US or Asia. Donald Trump was a climate change skeptic, of course, but Joe Biden most certainly isn't, and we can expect to see a degree of rebalancing during Biden's term in office. And there is certainly a lot of catching up to do. The U.S. is home to almost half of the world's managed money and assets, whilst Europe is the domicile for another 32.6% of global funds and assets. However, Europe accounts for more than 81% of global ESG investing, according to research from consultants PwC, whilst the U.S. total stands at just 14%. That should concern the U.S. money managers because the amount of money committed to ESG investing is expected to grow to $4.5 trillion by 2025, according to the PwC report. Sustainable investing just wasn't on the agenda under Donald Trump. However, investor attitudes in the U.S. are changing, and a survey of institutional investors conducted earlier this year by MSCI found that 78% of respondents plan to increase their exposure to ESG. That change in attitudes among money managers can also help to change behavior in corporate America. For example, in Europe, 40% of listed companies score highly on ESG criteria, whilst in the US that figure is far lower, at just 16%. Europe is also starting to eat the USA's lunch in the ETF market, with 96 new ESG-focused ETFs launched in Europe during 2021 as of early August. Flows into those funds reached $65.6 billion, which is just over half of the total of flows into European ETFs during the first 7 months of the year. The good news for U.S. investors and traders, however, is that they may not need to change that much themselves to take advantage of these changes. For example, RBC Capital Markets recently published a 36-page report that highlighted stocks on which its analysis had an outperform rating, but which also had the potential to attract ESG investments. Almost half of the names on the list are U.S. stocks, which are highlighted in yellow, and they include names like GM, which is seen as a company that could transition from a carbon-intensive business into one with a much smaller footprint as it moves to the production of electric vehicles. As more of the asset and money under management the U.S. begins to move in ESG investments, those companies which fit the bill should see their stock prices start to outperform those of companies that don't. In fact, that change is already happening. If we compare the returns of the S&P 500 ESG index, drawn in black, and compare those to the standard version of the S&P 500 index in red, we find that the ESG version of the index has outperformed its rival by almost 10% since April 2020. That's the kind of outperformance that anyone running money cannot afford to ignore. That's all we have time for this week. Make sure you do your own due diligence before making any investment decisions.